Jim Rogers helps us decode inflation versus deflation. And I'm going to explain this to you in 3 simple, fast steps. Step number 1, we've got to go over Jim's secret techniques for analyzing the market. And it starts with a chart of cotton going all the way back to 1825 to 1880. On the left-hand side, we go from a whopping 10 cents up to 30 cents. Editor, throw up this chart. This is one of the coolest charts I have ever seen. I almost wanted to make it a screensaver for my cell phone. This is old school. And right here on the George Gammon channel, we look at all the data. We don't have recency bias going back 5 or 10 years. No way. Just like Jim Rogers, we take it all the way back to the 1800s. So in 1825, the prices of cotton right around, call it 12 cents, maybe. They go down a little bit, come up to 20. Holy cow, a bubble. And then they come all the way down to, who knows, a penny, a half a cent. And then they come back up to their historic trend line, we'll call it, at 10 cents. And then prices go parabolic, straight through the roof. They literally go off the chart. I've never seen a chart where the prices literally go off the chart. They are proper Buzz Lightyear prices to infinity and beyond. They come back down all the way to about 15 cents, pop back up in 1880, right back where we started, about 10 or 11 cents. So the question becomes, what on earth drove prices from, call it a half a penny, all the way up to who knows, because we can't even see the prices on this chart. With my research, they went up to probably $1 or $1.20. To dive into this further and to understand how we can use this specific chart to decode the current day debate of inflation versus deflation, let's go to a clip from my full-length interview with the man himself, Jim Rogers. So let's go back to your days at Columbia and try to use this as more of an instructional question. And I know back then you would have your students look at charts. And I know you're not a big fan of technical analysis or anything like that, but you would have them look at charts and see anomalies. Going back to the 1800s, I think even further back than that, in different commodities and stocks and markets. And then you'd have them try to figure out why the anomaly took place and what could they have done to foresee it happening. So do you still think that's a good approach for someone that's trying to learn how to invest in today's day and age? Would you have them do the same type of thing?
I did not have them look at charts as chartists.
Right.
I had them look at the chart to get the historical perspective so that they could see, oh, this stock or this whatever shot up at such and such a time. Why did it shoot up? Or what caused that? And how would you have figured it out? In fact, if you go back and look at cotton in 1861, cotton went from half a cent to $1 in 6 months. Now, I was not long. I wish I'd been around for that move. It would have been a fantastic move for anybody who had the good sense to foresee what was coming. And that's this kind of thing. I said, okay, guys, look it up and see what happened.
So the key to Jim's first technique is to look at historic charts, look for anomalies, and then ask yourself what happened? What drove this price move higher or lower? Then you've got to figure out how you would have predicted the specific price movement given the information they had at the time. This is a fantastic learning technique, but it's also a tool that you can use going back in history, looking at chart patterns, asking yourself what happened, figuring it out for yourself, and then using the knowledge to build a framework for today and what may happen in the future, regardless of whether it's the price of cotton, the price of oil, the price of gold, or whether we're going to see inflation or deflation. But the techniques we can learn from Jim Rogers to become better investors don't stop there. For technique number 2, let's go right back to my interview with Jim.
You look for a change. You look for something that's expensive. And often, if you get it right, something will go from dirt cheap to a bubble, or certainly very overpriced over a period of years, and everybody gets excited. I think you probably know what overpriced looks for. Everybody's talking about it. Everybody says it can never go down. Everybody says, oh, don't you know, this time it's different.
Yeah.
Very dangerous words, George, as you know, when they say this time it's different. You don't understand. Those signs are pretty common. They happen all over the world in all markets when something gets overpriced. And if you'll know if it's expensive, you'll know if there's wild enthusiasm. And then if you see something changing, then for the negative, then you start to act. At least that's how I try to act and how I try to sell. And likewise, when things are cheap, back to Germany in those days. Well, I mean, Russia, I was negative on Russia for decades. But for a variety of reasons, I came to the conclusion that there was change taking place in the Kremlin. I can tell you why I think it, but who cares? I think that I see change taking place. For 100 years in Russia, they didn't like capitalists. They didn't like rich people. They shot you or put you in jail or took your money and then put you in jail. But I think I see vast changes in the Kremlin and the psyche of the people. And so that's why I decided, and it was very cheap, and that's why I decided to invest in Russia. That's the sort of thing you look for.
So the second key technique to understanding when you should buy an asset or when you should sell is to look for a catalyst. Is there something significant that happened that will most likely drive the price up or drive the price down? Going back to our chart of cotton, what happened in 1860 that drove the prices literally off the charts? Of course, it was the Civil War. The South produced the majority of cotton for the United States. So when war broke out, supply plummeted and the prices went to infinity and beyond. Now let's use what we've learned from Jim Rogers in steps number 2 and 3 to try to predict whether or not we're going to have inflation or deflation. Step number 2! Now let's dive into some chart anomalies regarding inflation and deflation. I've got a chart of the U.S. inflation rate going back to 1910 all the way to 2000. On the left, it goes from negative 10% all the way up to a positive 15%. So inflation skyrockets. World War I comes crashing all the way down in 1920. Notice I put depression here. Most people forget we went through a severe depression, 1920 and 21. In fact, when you look at the frontline numbers, such as deflation and unemployment, it was worse than the 1930s, but it goes right back up roaring 20s where inflation was pretty darn stable. We know what happens in 1930. Deflation kicks in again, goes all the way down to call it 10%, and the middle of the decade goes back up. Then we have World War II and price controls. This is when inflation really kicks in again. The 1950s stabilizes all the way to 1970s. Then we have price controls again. We go off the gold standard, several different contributing factors. And then we have high inflation throughout the 1970s, as most of us remember. 1980, of course, Volcker comes in, smashes inflation by jacking rates all the way up close to 20%. Inflation comes back down, and since then, it's been rather tame, if you believe the government's CPI numbers. And that's a whole separate video. But for right now, we'll assume they're accurate. So using what Jim Rogers taught us, let's go through this chart and see if we can find any anomalies or things that we find interesting. The first thing that comes to my mind is when we think of the 1930s, we think of this entire decade of deflation where prices went down further and further and further. And the only thing that saved us from declining prices was World War II. But if we look at this chart, we see that's absolutely false. In the beginning of the decade, yes, prices did go down, but once we got to 1934, 1935, prices went right back up higher than they were throughout the 1920s. We almost got up to a 5% inflation rate 1935, 1936. And for the latter part of the decade, we didn't have deflation at all. In fact, contrary to popular belief, we had pretty substantial price inflation. Another thing I'd like to point out is since the early 1930s, the United States hasn't seen another bout of significant deflation. Pretty much all inflation since the early 1930s. So the next question becomes, what happened in the mid-1930s that could have changed everything? What anomaly took place that we need to be aware of so we can determine going into the 2020s if we're going to see inflation or deflation? Well, in 1935, they passed the Social Security Act, which included unemployment benefits. Also, in 1938, they passed the first minimum wage. Editor, go ahead and throw up another chart of inflation, deflation in the United States, and this becomes extremely clear. Prior to 1935, 1938, we had bouts of deflation, inflation, just going back and forth and back and forth. After 1935, 1938, that time period, we have seen nothing but inflation. So you may be saying to yourself, okay, George, I get it. I understand that we implemented Social Security, unemployment, and a minimum wage, but I'm not connecting the dots. How does that play into the United States having almost constant inflation for the next 8 decades? Let's dive into that further. First, in 1935, let's see what happens when the United States implements Social Security and unemployment. To be clear, that Social Security payments didn't start going out till around 1940. But the bottom line is it increases demand in the real economy. Prior to 1935, the United States government really didn't have a way of transferring money directly to the people for them to go out and spend. But through unemployment benefits and Social Security, now all of a sudden the U.S. government is writing checks directly to the everyday person out on the street. Therefore, they have more money to buy homes, cars, cows, corn, or cotton. And if you're not familiar with my videos, those are the commodities I use whenever I give an example of a super simple economy. So moving on to the supply side, it gets a little more complex. In 1938, they institute a minimum wage. Well, let's think through this from a standpoint of a business where 100% of their expenses are wages. So if you have business XYZ under normal conditions, their revenue is on the left, expenses on the right, their revenue is slightly higher than their expenses, so they've got a bit of a profit there. They're good to go. But if we go through a recession or a depression, their revenues significantly decline. If they don't have flexibility in their wages because of a minimum wage, they go out of business. Therefore, the supply dramatically goes down because this business isn't even functioning anymore. But in a free market system that doesn't have a minimum wage, the revenues will go down, but their expenses would go down as well. They would just reduce wages. Therefore, they would still be able to produce their product. Granted, they might be producing less than they were before the recession or the depression, but they wouldn't completely be out of business. So what we have here is demand going up because the government is now transferring payments directly to people in the real economy, and supply potentially being restricted. Because if we have a significant downturn in the economy, you have a lot more businesses just shutting their doors instead of just lowering wages. And let me be very clear, I'm not saying that unemployment benefits, Social Security payments, and the minimum wage are the only reason we haven't seen big bouts of deflation in the United States since the early 1930s. What I am saying is they most likely were significant contributing factors. Step number 3! Now let's use the knowledge we obtained in step number 2 and try to find a catalyst that'll help us predict whether or not we will see inflation or deflation in the future. So in step number 2, we know that unemployment and Social Security benefits increased demand. The minimum wage decreased supply. Therefore, since the early 1930s, whenever we've had a downturn in the economy, a recession, it's kept the CPI artificially high. In other words, it's kept inflation higher than it otherwise would be. Now let's go to a recent interview with Lacey Hunt and my good buddy Eric Townsend from Macro Voices, where Dr. Hunt lays out one of the best arguments for deflation I have ever heard, as well as laying out a fantastic argument for hyperinflation.
The first round effects may appear to be appealing. I mean, wanting to bail people out in a time of crisis, people get a check. They think that's good. The problem is in economics is that they're the unseen effects, the second, third, and fourth round effects. And I don't like to use the term good or bad, but there's a little exercise that folks can do. If you graph government debt to GDP on one axis and the long bond yield on the other axis, and you do that for the United States, what you'll see is that there is an inverse relationship. That as the government debt levels go higher, the bond yields decline. And the logic here is that you are triggering the law of diminishing returns, and you're reducing saving to weaker and weaker levels that precludes physical investment. And by the way, if you do that exercise for Europe, for Japan, and now China, you'll see that the inverse relationships hold. And so what we're talking about is understanding the economics. And the economics suggests that if we pursue this policy, we're going to get weaker growth and lower inflation and a prolonged period of low interest rates. Unless, of course, the central bank, Federal Reserve, is allowed to print money. And in that case, we will not improve the growth rate one iota. In fact, the growth rate will probably even get worse because we will experience a severe decline in productivity. In extremely high inflation, people do not hold financial assets. They spend time converting the financial assets as quickly as possible into commodities. And then they trade those commodities with other people who have things that they want. In other words, you have to have double coincidence of wants, which is extremely inefficient. And so productivity will fall and the economy will lapse into an even deeper morass than it is now. So the money printing is an absolutely horrendous option. It may be used, though. And if it does, you'll see a change in my forecast. Absolutely.
So the catalyst Dr. Hunt refers to is the difference between the Fed buying assets and spending money or printing money. Let's take a look at how that works in real life. The Fed is connected to the primary dealer banks A, B, and C. When the Fed buys assets, they usually buy these assets from one of these primary dealer banks or a bank under the Fed's umbrella. So in this case, Bank A or Bank B or Bank C is selling treasuries directly to the Fed. The Fed takes the treasuries, puts them onto the asset side of their balance sheet. On the liability side of their balance sheet, the Fed prints up or creates funny money or bank reserves that it deposits with the account of the bank that sold them the treasuries. Let's remember the liability side of the Fed's balance sheet are these bank reserves, and how those look. They're just like bank accounts or checking accounts that you have with Wells Fargo, Chase, Bank of America, whatever. But the primary dealer banks have these checking accounts with the Fed. So primary dealer bank A, B, and C, they all have these checking accounts. So when the Fed prints funny money or bank reserves, they go into one of the reserve accounts for the banks. Another way to look at this is, let's just say you have $10,000 and you stuff it under your mattress. It's not going anywhere. It's not going to create more demand in the real economy. Why? Because the money's under your mattress. So let's just pretend for a moment the Fed actually has a bed and a mattress. We'll call it the Fed bed. On the Fed bed, there's 3 different sections. One section for primary dealer bank A, B, and C. So they're taking these bank reserves and stuffing them under the Fed bed. And Bank A is putting it in their area, Bank B in their area, Bank C in their area. But it never leaves the mattress. It stays under the Fed bed forever. Why is this? Because let's go through 3 different scenarios. So the Fed buys assets or treasuries from one of the banks. We just discussed that. The treasuries go to the Fed onto their balance sheet. The funny money goes under the Fed's mattress. Bank A buys a bond from Bank B. Okay, in that transaction, the treasury would go from Bank A's balance sheet to Bank B's balance sheet. But all they would do to pay for the transaction is just transfer bank reserves held at the Fed or underneath the Fed bed from Bank A to Bank B. And then Bank B, let's say, buys mortgage-backed sausages from Bank C. The only thing that happens there, again, is Bank B takes their funny money from their side of the mattress and moves it to Bank C's side of the mattress. Again, regardless of which one of these 3 transactions you look at, the reserves, the funny money, has never left the Fed. Contrast that to the Fed actually spending money. We'll use Dr. Hunt's words. So what he's referring to is, if the Fed, instead of buying an asset from one of the banks, if they just went in and paid for a bridge to be built, or maybe they paid for universal basic income, the money goes directly into the real economy. This creates more demand for houses, for cars, for commodities, and it creates more demand for restaurants. We'll just use Joe's Cafe as an example. But Joe's Cafe also has bigger problems. Remember, they've got to deal with the minimum wage. So if we go through a recession, they're going to have a hard time staying in business because they can't drop their wages very much. Yes, they can hire fewer employees, but that also reduces supply. So while the Fed is creating additional demand, spending money into the economy, regardless of what you want to call it, whether it's helicopter money, MMT, UBI, printing money, however you want to phrase it, it's creating more demand. This is happening at the same time when we could be seeing a reduction in supply because wages aren't flexible. They're very sticky. But let's also remember, with the cerveza sickness, we could see a lot of the supply chains, the global supply chains, being disrupted. And as you know from watching my videos, most of the stuff we consume in the United States isn't produced in the United States. It's produced in country XYZ, ABC, and 1, 2, 3. So if we have fewer countries producing stuff for the United States, it also decreases supply. But if you watched my videos last week, you'll also remember that the government right now, your drunk, insolvent Uncle Sam, is actually competing with businesses for their employees by substantially increasing unemployment benefits to the point where most employees are making more money staying at home than they are actually going into work and producing more stuff or increasing supply. So today, the catalyst we need to look for is the Fed increasing demand in the real economy by spending money directly into the economy instead of just creating bank reserves. They would do that through MMT, helicopter money, UBI, whatever you want to call it, or just monetizing directly the government debt. So government comes in, spends money on an infrastructure project, they issue bonds, the Fed buys those bonds directly from the Treasury or just in a roundabout way through the primary dealer banks. Regardless, this increases demand substantially, and it's exactly what Dr. Lacey Hunt is referring to. Then on the supply side of the equation, we really need to pay attention to how many businesses are actually going bust, what's happening to the supply chains, what's happening with the political narrative of de-globalization, and how is it playing out with unemployment benefits, keeping people from going back to work, creating goods and services we need in the economy, reducing the supply. And then it's just a simple equation of what is going down and what is going up. So if demand is going up while supply is going down, you're going to see inflation. If demand is decreasing at a faster rate than supply is decreasing, then you're going to get deflation. But those are the catalysts we need to look for. For more content like this that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I'll see you on the next video.